Britain's housing dream is collapsing before our eyes, and it's not by accident, it's by design.
Britain's housing dream just slammed into a wall. Prices are stuttering, mortgage rates bite, and buyers are freezing mid-step. Wages can't catch rising costs, landlords exit, and London, the old engine, misfires. Behind the headlines sit the real triggers: policy jitters, thin confidence, and a market stuffed with stale listings. Tonight, I'll cut through noise and show where the pressure truly builds, why affordability snapped, and how this slowdown spreads from first-time flats to prime postcodes. Stay with me, because the next 10 reasons aren't rumors. They're the mechanics holding prices down and the signals you need before making your next move today. Number 1. Elevated mortgage rates. The single biggest force behind the slowdown in the UK housing market is the persistence of high mortgage rates. For almost 2 years, the Bank of England has kept rates elevated to control inflation, but that same medicine is cooling the property sector. Buyers who want secured loans below 2% are now facing rates closer to 5 or 6%, making monthly repayments hundreds of pounds more expensive. Even a small rise in interest rates drastically changes affordability, especially for first-time buyers who are already stretched. Many households that once dreamed of owning a home have been forced to step back, waiting for more stable borrowing costs before committing to long-term debt. The effect ripples through every layer of the market. Sellers are cutting prices to attract fewer qualified buyers, while lenders have tightened their criteria to minimize risk. Estate agents report that transactions are down by nearly 15% compared to last year, a clear indicator of hesitation. Those still buying are opting for smaller properties or moving to cheaper regions, reshaping demand away from major urban centers. Fixed-rate mortgage holders who secured low deals during the pandemic are also bracing for higher payments once their current terms expire, creating an air of uncertainty that further suppresses confidence. Economists now estimate that these borrowing costs could remain elevated well into 2026, keeping property activity subdued. Even though inflation has begun to cool, the Bank of England remains cautious about cutting rates too soon, fearing a resurgence in prices. For homeowners, this means a prolonged period of financial restraint and slower equity growth. For potential buyers, patience might be the smarter move as the market adjusts to a new normal where money is no longer cheap and property decisions require careful long-term planning. Number 2. Affordability crisis: stagnant wages versus rising costs. Another major reason the UK housing market has hit a wall is the widening affordability gap between what people earn and what homes cost. Over the past few years, wage growth has failed to keep up with inflation, energy bills, and general living expenses. Even though average pay has risen slightly, the increase is quickly eroded by higher food prices, transport costs, and household bills. For many, saving for a deposit has become nearly impossible. A typical first-time buyer now needs over £60,000 to secure a property in southern England, a figure far beyond reach for most working families. The dream of home ownership has become distant, creating frustration and stagnation in the lower and middle tiers of the market. As affordability shrinks, demand weakens and price momentum slows. The affordability index shows that buyers are spending close to 40% of their income on mortgage repayments, the highest share in more than a decade. This imbalance has forced many young professionals to delay purchase plans, remain in the rental sector, or move back in with family to cut costs. Sellers, facing fewer offers, are either lowering asking prices or withdrawing listings altogether. The result is a standstill, where neither side can move easily. Buyers lack financial room, and sellers refuse to sell at heavy discounts. This pressure affects the wider economy as well. Consumer spending dips when households allocate more income to housing or rent. Retail, hospitality, and services see slower growth, feeding back into weaker economic activity. The affordability crisis is no longer just a housing issue, it's an economic bottleneck. Without significant wage growth or lower borrowing costs, this income-to-price mismatch will continue to limit recovery and define the tone of the UK property market for years ahead. Number 3. Tax and budget uncertainty. The third factor halting momentum in the UK housing market is the growing uncertainty surrounding government fiscal policy. With the next budget announcement looming, buyers and sellers alike are pausing big financial decisions until they understand what new tax measures might mean for property. Rumours of adjustments to stamp duty, potential revisions in capital gains tax, and regional property levies have all contributed to hesitation. Many homeowners are holding back from listing their properties, fearing that new policies could affect final sale values. At the same time, first-time buyers are unsure whether to act now or wait for possible government incentives aimed at affordability relief. This wait-and-see attitude has created a cooling effect that goes beyond traditional market cycles. Transaction volumes have dipped, not because people no longer want to move, but because they're unsure what the financial landscape will look like in the coming months. Estate agents across London and the South East report a noticeable slowdown in offers as clients prefer to wait for clarity. Budget speculation is effectively acting as a self-imposed freeze, making the market appear weaker than it might actually be. Analysts from several financial institutions have suggested that even the hint of tax reform can temporarily suppress activity by up to 10%. Such volatility damages confidence in long-term planning. Developers, uncertain about future tax exposure, are delaying new projects, which in turn reduces construction jobs and housing supply. Investors are becoming cautious too, reallocating capital towards safer asset classes until fiscal policy steadies. The longer this policy ambiguity lasts, the more difficult it becomes for the market to regain momentum. Stability in taxation and clear budget communication will be crucial if the UK hopes to revive housing demand and restore predictable pricing trends across all regions. Number 4. Regional disparities and London weakness. While national averages suggest the UK housing market is merely slowing, a closer look reveals deep regional disparities. London, once the unstoppable engine of property growth, is now dragging the overall numbers down. The latest government data shows that London house prices have fallen by 0.3% year-on-year, with an average property price around £566,000. Meanwhile, northern regions, such as the North East and Yorkshire, are still recording moderate gains, some as high as 6%. The capital's slowdown has become symbolic. When London cools, the rest of the market often follows. International buyers, previously a key driver, are also retreating due to tighter visa rules, higher taxes, and a stronger pound reducing foreign purchasing power. This divide is creating a two-speed market. Affordability outside London remains comparatively stronger, attracting families and remote workers who can now live further from major business hubs. The pandemic's work-from-home shift continues to echo through buyer behavior, with many prioritizing space and value over proximity to hubs. As a result, commuter belts in the Midlands and North are seeing demand hold steady, while central London flats linger unsold. This imbalance skews national data, making it harder to interpret market strength accurately. It also reshapes the geography of wealth as investment and development move toward previously overlooked towns and cities. The broader consequence is structural change. London's decline in relative value affects everything from rental yields to construction planning. Developers are shifting focus towards smaller regional projects rather than luxury high-rise builds. Local councils across the UK are beginning to see renewed attention from both private and institutional investors, balancing decades of uneven growth. Yet until London stabilizes, national sentiment will remain cautious. The UK housing market's health still depends heavily on its capital, and right now that heartbeat is faint. Number 5. High-value segment stalling. The slowdown is most visible in the high-value property segment, where luxury homes that once sold in weeks are now sitting on the market for months. Properties priced above £500,000 have seen a steep decline in demand as buyers become more price-sensitive and mortgage options tighten. Wealthier buyers are not immune to higher interest rates or uncertainty about future tax policies. Many are reevaluating whether to purchase now or wait for potential price corrections. Estate agents in London's prime postcodes report growing inventories, with discounts becoming the norm rather than the exception. The psychology of scarcity that once drove quick sales has been replaced by caution and negotiation. At the same time, international demand for luxury property has softened. Foreign investors, once dominant in high-end markets such as Mayfair and Kensington, are facing increased costs due to currency fluctuations and new non-resident tax rules. The once lucrative appeal of UK property as a safe global asset has dulled amid concerns about political stability and slower capital appreciation. This retreat of foreign capital reduces liquidity, leaving sellers exposed to longer listing periods and steeper price cuts. Developers focusing on premium projects are beginning to scale back, postponing or redesigning developments to meet mid-market demand instead. This contraction at the top has a cascading effect throughout the housing chain. When luxury properties fail to move, upgraders delay selling, which restricts the flow of inventory across lower price brackets. Consequently, fewer transactions occur at every level. The stalling of the high-value market is not just a symptom of economic caution, it's a signal that the era of endless upward property inflation may be ending. Stability in this tier is crucial, as it often sets the tone for confidence across the entire UK housing landscape. Number 6. Increased supply and zombie listings. Another subtle but powerful reason the UK housing market has hit a wall is the rise of zombie listings, properties that linger unsold for months, withdrawn and later relisted without real buyer interest. This illusion of activity makes the market appear busy, but in reality it's clogged with homes that buyers have already rejected. Data from major property portals shows a growing backlog of unsold listings, with some homes being marketed for over 200 days. Sellers are reluctant to lower prices significantly, hoping conditions will improve, while buyers remain cautious and selective. This mismatch between price expectations and purchasing power has created a stagnant pool of inventory that keeps the market heavy and slow-moving. At the same time, new housing supply has risen modestly as developers rush to complete ongoing projects before potential tax or planning changes. More homes on the market might sound positive, but with limited demand, this additional supply only spreads buyer attention thinner. It also pressures sellers to compete more aggressively on price, incentives, or mortgage support offers. The imbalance between the number of listings and the number of active buyers is now at its widest point since 2013. The longer this persists, the greater the likelihood that prices will soften further in regions already struggling with excess stock. For buyers, this means more choice, but also more confusion. A crowded market filled with stale listings makes it difficult to spot genuine opportunities. For sellers, the lesson is sharper. Unrealistic pricing in a cautious environment can leave a property invisible for months. The rise of unsold and recycled inventory highlights a deeper truth about today's UK housing market. Activity alone doesn't mean health. Until these zombie homes find real buyers, recovery will remain slow and uneven across most regions. Number 7. Economic growth, stagnation, and consumer confidence. A slowing economy is silently weighing down the UK housing market. With economic growth hovering near zero, many households are feeling uncertain about their financial future. Wage growth remains modest, and inflation, though easing, still eats into disposable income. People are saving more and spending less, a pattern that directly impacts big financial decisions like buying a home. When consumers lack confidence, they hesitate to take on new debt, even if they can technically afford it. The result is a freeze in housing activity that mirrors broader economic stagnation. Every property purchase requires optimism about future income, and right now that optimism is in short supply. Businesses are equally cautious, cutting back on hiring and expansion, which adds another layer of insecurity for employees. Analysts note that consumer sentiment indexes remain well below pre-pandemic levels, reflecting a mood of restraint. Families who might have considered upgrading their homes are instead holding on to cash or focusing on short-term financial stability. The slowdown in retail and hospitality also feeds into this loop. When people spend less, local economies weaken and regional housing demand declines. In short, the market is facing not a collapse, but a confidence drought that restricts mobility and ambition. Government forecasts suggest GDP growth for 2025 will stay below 1%, which means limited job creation and ongoing caution among lenders. Banks, wary of defaults, are maintaining stricter lending standards, making it harder for borderline applicants to secure mortgages. For a market that relies heavily on easy access to credit, this is a major constraint. The housing market thrives on belief in stability and growth. When both fade, so does momentum. Until the UK sees stronger economic expansion and renewed consumer confidence, house prices will likely continue to stagnate rather than surge. Number 8. Rental market pressure and shift in buyer behavior. The UK's rental market is under extraordinary pressure, and that strain is spilling into the property market. Rents have surged by over 8% year on year, making it harder for tenants to save for deposits. Many renters who once aimed to buy have postponed plans indefinitely, trapped in a cycle of high rent and limited savings. Simultaneously, landlords are facing tighter profit margins due to higher mortgage rates and new regulations on energy efficiency. Some are selling up altogether, flooding the market with ex-rental homes. Yet, these additional listings haven't translated into easy bargains. Buyers remain cautious and demand remains fragmented across regions. The shift from owning to renting or from investing to exiting has reshaped the dynamics of housing demand entirely. This shift in behavior reflects deeper economic anxiety. Young professionals and families are now prioritizing flexibility over ownership, choosing short-term stability instead of long-term commitment. The cultural mindset around homeownership is changing. What was once considered an essential milestone in adult life is now seen as a financial risk. Estate agents report that a growing portion of clients are asking about long-term renting options rather than mortgage plans. The combination of limited affordability and economic uncertainty has made renting a practical, if temporary, solution for many. This behavioral change reduces overall market churn and keeps transaction volumes low. Meanwhile, the shrinking pool of private landlords is putting additional pressure on the rental supply. With fewer rental homes available, rents continue to rise, trapping tenants even further. This vicious circle keeps first-time buyers out of the market and slows down the housing ladder from the bottom up. The interdependency between rent inflation and buyer hesitation is now one of the strongest barriers to recovery. Until balance returns between renting and buying, costs will continue to rise. Number 9. Regulatory and planning constraints. A less visible but equally powerful drag on the UK housing market comes from planning restrictions and regulatory complexity. Building a new home in Britain remains one of the most bureaucratic processes in the developed world. Local councils face backlogs, environmental impact requirements keep expanding, and public objections often delay approvals for months or even years. These layers of red tape mean that supply cannot adjust quickly to shifts in demand. Even when developers have the funds and the land, navigating planning laws has become a slow, unpredictable battle. The result is a system that keeps prices artificially high in some regions while limiting new opportunities elsewhere. Supply shortage once helped fuel growth, but now it prevents flexibility as economic conditions evolve. Developers, frustrated by constant delays and unpredictable policy changes, are scaling back projects or focusing on smaller schemes with lower risk. Greenbelt regulations, which protect rural land from development, further restrict expansion around major cities where housing is needed most. These constraints make it nearly impossible to match population growth with sufficient housing stock. The consequence is uneven availability. Some areas are oversupplied while others face chronic shortages. With construction costs rising and government incentives uncertain, many builders are choosing to wait rather than risk unprofitable projects, creating a cycle of limited progress and growing frustration. For buyers, this rigid planning environment translates into fewer choices and higher prices for new builds. For renters, it means continued competition for limited stock. Policymakers have acknowledged the issue, but reforms remain slow and fragmented. Without comprehensive planning reform, housing supply will stay constrained, keeping the market vulnerable to shocks. Even as demand softens, this structural rigidity ensures that prices do not adjust smoothly, making recovery uneven and preventing the housing sector from fully stabilizing. Number 10. Global and Brexit-related headwinds. The final, and perhaps most far-reaching reason the UK housing market has hit a wall lies in global economic turbulence and lingering Brexit aftershocks. The international landscape has grown more volatile, with conflicts, trade tensions, and fluctuating energy prices all feeding uncertainty into the British economy. Global investors, once enthusiastic about UK property as a stable asset, are reassessing exposure due to weaker currency performance and slower GDP growth compared with other advanced nations. Rising import costs have also inflated building materials and maintenance expenses, pushing construction firms to scale back projects. The UK, now operating outside the European Union, faces additional trade frictions that raise supply chain costs and delay housing completions. These global pressures combine to make the domestic market far more sensitive to external shocks than it was a decade ago. Brexit continues to cast a long shadow, particularly in labour and logistics. Construction companies are struggling with labour shortages after losing access to a steady flow of EU workers, causing higher wages and project delays. That lack of skilled labour restricts the number of homes being built each year, worsening affordability even as demand cools. Financial services, too, have felt the shift, with some investment and lending activity relocating to continental Europe. As a result, the pool of capital available for large-scale housing developments has tightened, especially outside major metropolitan areas. Fewer investors mean fewer cranes on the skyline, and slower economic multipliers feeding into local communities. Together, these global and post-Brexit factors create an environment of persistent caution. Developers hesitate to expand, banks lend conservatively, and buyers watch exchange rates before committing. The market is no longer driven solely by domestic forces. It is tied to an interconnected world economy that amplifies every tremor. Until global stability improves and trade efficiency returns, the UK property sector will likely remain restrained, cautious, and slower to recover momentum. The UK housing market now stands at a critical crossroads. What was once a story of endless growth has shifted into a delicate balance between inflation, interest, and uncertainty. Every part of the system, from first-time buyers to luxury developers, is feeling the chill. Confidence has weakened, affordability has cracked, and the once reliable London engine has lost its spark. Yet within this slowdown lies opportunity. Periods of adjustment often clear the noise, revealing true market value for those who act wisely. This is not the end of the housing dream, it's the end of easy money and the start of a more measured reality. The coming months will test resilience, not just wealth. If you've watched this far, it means you care about where Britain's property future heads next. So make sure you like, share, and subscribe for the next episode where we uncover which cities may rise as new housing hotspots in 2026. Drop your thoughts in the comments. Do you see recovery or reckoning ahead? And remember, informed citizens make stronger markets. Stay sharp, stay aware, and stay ready, because Britain's next housing chapter is already being written, and it's one you can't afford to ignore.